Good morning, everybody. This is David.
Are not familiar. One America is a very unique company. We were founded in 1877. So we're 138 years old this year, and we're a mutual insurance company, which has become exceedingly rare in this day and age. That means that we're not publicly traded. In fact, we're owned by our policy owners. And that's a very important thing. I would encourage you to explain this to your clients. All insurance companies are in the business for two things. Number one, to pay claims, and number two, to be profitable. The difference between a mutual company and a stock company is the order with which they prioritize those two items. So most companies want to pay claims, but ultimately their main goal is to be profitable. And with One America, it's exactly the opposite. We want to be profitable, but for us, profit is simply a means to an end. Our number one goal above all else is to pay claims. And every decision that we make, financially or otherwise, is done with the best interest of the policy owner in mind. Now, generally speaking, mutual companies tend to be some of the strongest companies in the industry, and One America is definitely no exception. We are an A-plus rated company from AM Best. What we're even more proud of, though, is our Comdex rating, which is a 95 out of a possible 100. And for those of you that don't know how Comdex works, basically, that's an aggregate score of all of your financial ratings, and then you're graded on a curve against all other companies. Simply put, it's a percentile. According to the Comdex rating, we're in the 95th percentile of all insurance companies in the United States when it comes to our financial strength. The other thing that's very unique about One America is we were the first company to create an asset-based long-term care product. We had this new idea in the late 1980s, believe it or not. At that time, the only thing going was traditional long-term care insurance. And we decided to take a little bit of a different approach here. We took a life insurance policy and allowed people to accelerate the death benefit for long-term care. And that was in the very beginning stages of the product. That was the most simple solution that we could think of at the time. And we released that product to market in 1989, and the first sale was made in January of 1989. That product is called Asset Care, and we still sell that product. We've made a lot of improvements and enhancements to it that we're going to talk about today. But the reason why I talk about the fact that we were the first company to offer an asset-based product is that really gives us a leg up on the competitors for a variety of reasons, but it allows us a lot of expertise. You'll notice that it seems like companies are coming out with asset-based products left and right. I mean, every time I turn around, there's a new company that's trying to create a version of what we started 26 years ago, but they don't have the expertise. They don't have the expertise of 26 years of creating these products or underwriting them or paying claims on them. And that 26 years of expertise really goes a long way. Before I get into the products themselves, just a little bit on what we're seeing out there in the marketplace and why I think long-term care planning is important. Now, I know this is going to be a review for a lot of you, but for those of you that may not be familiar with this information, I did just want to touch on it for a few minutes. We all know long-term care is expensive. The average cost of a private room in a nursing home last year was over $87,000. Now, thankfully, most people don't want to go to a nursing home. Most people would want to go to maybe an assisted living facility, or better yet, stay in their own home. And thankfully, that's a lot more reasonably priced than a nursing home. Home health care, depending on where you are in the country, maybe $40,000 to $50,000 a year. But the other thing we have to consider is not just what long-term care costs today, but what might it cost 10, 15, 20 years from now when your clients reach the age where they might actually file a claim. If we assume just a conservative rate of inflation of 3.5%, in 10 years, the average cost of a nursing home will be over $123,000, and in 20 years, it will be almost $175,000. Now, that's a big number. Remember, that's per year. And obviously, they call it long-term care for a reason, right? It generally lasts a lot longer than a year. The other thing I want to touch on is some trends that we're seeing that are having a big impact on the cost of care, but also the number of people that are needing care and the duration of long-term care claims. And I'm just going to touch on two of these here. The first trend that we're seeing is the baby boomers. We all know that the baby boom generation is reaching retirement age. There were over 70 million babies born in the United States between 1946 and 1964. Now the oldest boomers are 69 years old. The youngest are in their early 50s. Well, in the next 10 to 15 years, they're going to all begin to reach the age where they might need long-term care. And so one of my colleagues calls it the silver tsunami. It's coming, right? We can't stop it. Well, at that time, we know there's going to be a huge demand for long-term care services. What we don't know is that there's going to be enough supply. We hope there is, but if there's not enough supply to meet the demand, then the cost is going to go up. And the average cost per year might even be higher than what I'm showing on the screen here today. The next trend that we're seeing is medical technology, doing great things for our bodies, but haven't figured out a way to cure our minds. So we're seeing two things here. Number one is longevity due to medical technology. And we know that the longer you live, the greater the chance that you'll need care. 50, 60 years ago, long-term care insurance didn't exist. And that's because long-term care really didn't exist. People were living to 50 and 60 years old at that time, and it really wasn't likely that you would need care. You wouldn't get Alzheimer's, dementia, have a stroke, or get old and frail. But now that we're living to 80, 85, 90, chances are, unfortunately, if you live that long, something's going to go wrong with your health. And then, unfortunately, claims are getting longer because of medical technology is keeping us alive. So we're seeing a lot greater instance of Alzheimer's, dementia, things like that. The next thing I want to talk about is the average duration of long-term care. And we've all heard these statistics, around 2.5 years for men, maybe 3.5 to 4 years for women. And then we can multiply that times what we anticipate the average cost would be in 20 years, and then we come up with these huge numbers. The average man might need $400,000 or so to pay for his care. The average woman, almost $650,000. God forbid one person gets Alzheimer's, they might need $1.4 million. Well, just a quick comment on averages, if I can. I think that averages are valuable, and we should know those numbers, but I don't think that we should be creating long-term care plans for our clients based on these average durations. And there's two reasons I say that. Number one, it's almost impossible for us to calculate what the actual average duration is of long-term care, because a lot of it is just simply impossible to measure. And what I mean by that is a lot of people that need care, they try to stay in their home as long as they can. And maybe they have a friend, one of their children or their spouse take care of them informally for 6 months, 12 months or more. And then maybe they hire someone informally, not a professional home care agency, but they hire someone for, $15, $20 an hour to come take care of them. And then finally, as their care progresses, they do move to an assisted living facility or a nursing home. Well, in that case, the clock starts when they go into the facility, because that's when we can actually measure it. So in reality, the average long-term care claim is probably longer than 2.2 years for men and 3.7 years for women. But here's the other problem with creating long-term care plans for your clients based on averages. Think back to grade school when we learned about statistics and the definition of average. Average is a midpoint between extremes, and average loosely means 50% of the data falls below the average and 50% falls above. For example, the average man is 5'8" tall. Well, some are 6 feet, some are 5'5", some are 7 feet. It's the same with long-term care. The fact that the average claim for women is 3.7 years doesn't mean everybody's going to need care for 3.7 years. And in fact, some people are going to need care for 3.7 months, and some people are going to need care for 8 years or 10 years. So what I'll talk about in a little bit is a feature that we offer on our policy, which is very unique in this day and age. We call it the lifetime benefit rider. And it's a guarantee that no matter how long you need care, your policy is never going to run out. And that's one of my favorite features of our contract. The last statistic I'm sure you've all heard about, they say 70% of Americans will need care at some point in their life for some duration of time. So long-term care planning is extremely important. I think it's probably the most important piece of a retirement plan. Because our clients have saved for 40 or 50 years to be able to retire. And if they don't have a long-term care plan in place, in 4 or 5 years, it could literally destroy all the plans that they had put in place for their retirement. The planning is really important, but how do we get our clients to understand how important it is? I don't think the statistics alone are enough to get our clients to understand how important long-term care planning is. I think to really bring this home, we need to talk about how being unprepared for long-term care would affect the people that they love. Obviously, money is important, but there's one thing that's more important to a lot of people than money, and that is their family. So how does long-term care affect the people that you love? Well, if you're unprepared for care, a lot of times you're forced into a situation where you have to rely upon your spouse to be your caregiver. And just think about that for a minute. Most people need care in their early to mid-80s on average. So we've got an 85-year-old couple. All of a sudden, the husband has a stroke and he needs care. And he needs help getting lifted out of bed every morning and into his wheelchair and rolled around the house and fed his meals and lifted out of his wheelchair and into the bathtub and so on. Do we really believe that an 85-year-old spouse is going to be able to provide that type of care for him? Probably not. And if she is able to provide the type of care that he needs, it's still going to have a significant impact on her well-being, physically and emotionally. And she may be dealing with her own medical issues at that time. And what happens to her health if she's forced into a situation to be a 24-hour caregiver for her husband? That's just not a good idea. But people are forced into that situation when they don't do the proper planning. The other people that can be significantly impacted are your adult children. I hear people say, I took care of my mom. My son or daughter is going to take care of me. Well, I hate to break it to you, but times have changed. In this day and age, there's 2 working parents in most families. We all spread out for jobs or marriages. In this day and age, you're really asking your son or daughter to probably quit their job and sell their house, leave their church, leave their friends behind, and come and move home and take care of you for 4 or 5 years. Is that something you'd really want, or would you want to move in with them? What type of impact would that have on their family, their own children, their own grandchildren, their spouse? So it can have significant impacts on the people that you love. I think ideally, the best thing to do is put a plan in place that gives you the resources to be able to hire a professional caregiver so that your family is not impacted and your finances are not impacted. So how can you have a plan to have the resources to have professional care? Well, most people only know of 3 different options when it comes to answering that question. Today, I'm going to educate you that there's a 4th option, but most people only know of 3. Most people know that, the government has a program that would cover me if I needed care, but I don't qualify because I have assets, and that's Medicaid. Most people know in this day and age that Medicare is not going to cover long-term care expenses. So really, although that's an option for some people, it's probably not an option for 99% of the people that you talk with. The second option that you have is traditional long-term care insurance. I'm sure many of you know that very well. It's a great option for some people. Funded generally with annual or monthly premiums. The best thing about traditional long-term care is it will give you the resources to be able to hire a professional caregiver so you won't have to pay for it out of your own pocket, and it's not going to devastate you financially if you need care, and it's not going to bear significant consequences upon your family. But what we've also seen is that some people look into purchasing traditional long-term care insurance, and for some reason they decide not to. So as a company, one of the things we've looked at is, what is it about long-term care that some people begin to look into it and then they end up not purchasing it? And obviously one of the things that we hear is, well, if I don't use it, I lose it. And this is one of the main reasons why 26 years ago we decided to create a new type of long-term care. What we set out to do was, could we create a product that had long-term care benefits and all the advantages of traditional long-term care insurance, but there was an element to it that if you didn't use it, you didn't lose it. And obviously life insurance was a perfect chassis for us to put the product on to help us accomplish that goal. The third thing people could do is self-fund, And I know that you can easily paint a picture for them of why that's a bad idea, but it's pretty obvious. Your entire portfolio is at risk. Depending on how long you need care, you're going to spend your own assets dollar for dollar, and most people's portfolios are not set up for that. There's computer models you can run analysis. If at age 80 you need $100,000 a year for care, what's it going to do to your retirement plan? You can see the thing completely implode. So some type of planning has to be done. The question is, what type of product is right for your client? Well, right now I'm going to explain what we call asset-based long-term care planning. I'm not explaining a particular product here. I'm just explaining the concept of how this works and how we position it to our client. So let's say we have a client that maybe we've shown traditional long-term care to them and they've decided against it. They said, I'm just going to self-fund. Well, we know if they say that, they don't like the idea of self-funding. Nobody does. When a client says to me, you know what, I just want to self-fund. In my head, I'm thinking, no, you don't. I'm thinking, you don't want to self-fund. Nobody wants to self-fund. But there's something about the traditional long-term care product that you didn't like. So if we pose the question this way to every one of our clients, would you rather pay for your own care, or would you rather have someone else help you pay for your care? Everyone would choose the latter. So I believe that there's a long-term care plan for everybody out there. It's just a matter of which one fits their situation best. So let's say we have someone who's not interested in the traditional insurance. What I would do is I would draw a circle like this on the screen here, and I would say, within this circle exists all of your assets. So let's say, this represents your 401k, your IRA, your savings account at the bank, your stocks, your bonds, your real estate, everything you own is in this circle. Mr. and Mrs. Client, let me ask you a question. If you did need care, can you agree that you would have to decide where to get that money from somewhere in this circle? And we know that's kind of a rhetorical question. Obviously, the answer is yes. So here's a deeper question. That being said, have you ever thought about which one of your assets you would likely spend first if you did need long-term care? So we know we'd have to spend one of the assets, but let's try to get them to figure out which one would they likely spend first. Now, it doesn't matter what they say. Maybe they say, well, I've got a ton of money in my IRA or my 401k. That's the money I would use. Or maybe I've got, some savings accounts at the bank. That's the money I would use first. Or maybe I have an annuity. It doesn't matter. But the point is, let's point out that asset. Let's highlight it. And what I call that is I say, okay, that's your long-term care money. That's the money that you would be comfortable spending on care if you needed it. But more often than not, there's maybe $100,000, $125,000 in that type of account. But they really don't have much more assets than that they could reasonably spend on care. Why do I say that? Well, most people's portfolios contain assets that are meant for some specific purpose. So if this couple's okay with spending the $125,000, they probably don't want to spend much more than that because these other assets are designed to produce income or do other things. So there's a problem with their current plan, and the problem with their current plan is it's limited and it's not going to be enough. We talked about earlier, the average man might need $400,000 to pay for care, the average woman over $650,000. So what we would do is we would reposition those dollars. Now, in a way, this is a premium, but I don't like to use the word premium here. I like to use the word repositioning of dollars, because most of these plans have significant cash value, and in some cases, they even offer something called a guaranteed return of premium, where they can get all their money back at any time. So I like the word repositioning your assets, and we're going to reposition those into a plan that's going to provide them much more than they initially invested to help them pay for care. And I'm using an example here with our lifetime benefits rider. So the picture that I'm painting here is, right now, if you leave your money where it is, you've got $125,000. The problem with that is if you need $500,000 for care, you've got to go find another $375,000 from your own assets. As an alternative to that, let's take that money and reposition it into an asset-based long-term care plan And now, if you need $500,000 to pay for care, the insurance company is going to cover it. That's the concept of our programs. So we really offer two different plans and then several variations of each. I mentioned the first product we created in 1989 is called Asset Care. Today there are three very popular versions of the product. They all do the same thing, they're just funded differently. So the original Asset Care was a single premium solution funded with cash or cash equivalents. So money from the bank, or we've got stocks and bonds that we can sell and turn them into cash, and we can fund Asset Care 1. Well, the most similar product to Asset Care 1 is what we call Asset Care 4. And Asset Care 4 is the exact same product. It's just not funded with a lump sum. See, there's a misconception out there in the industry. People think that asset-based long-term care products are funded with a single premium only. And if my client likes the concept, but they don't have a lump sum, they can't buy it. They have to buy traditional long-term care insurance. Well, today I'm going to explain to you why that's not true. We're the only company that has an asset-based product with complete funding flexibility. You can fund it with a lump sum, that's what we call Asset Care 1, or you can get into Asset Care 4, which is basically just every other option on how you want to fund it. You want to do a 10-pay, a 15-pay, a 20-pay. What about guaranteed annual premiums for the rest of your life? We call that whole life pay. The next thing I'll touch on briefly is Asset Care 3. Again, the same product, funded with a single premium of qualified money. That's money from an IRA, 401k, etc. And after I'm done with that, we'll talk about the second product that we offer, which is called Annuity Care. Here's a basic example of Asset Care. The first thing we're going to do is we're going to pay a premium. In this example, the premium is a single premium of $125,000, and that's going to be used to buy a life insurance policy. And the life insurance policy has a death benefit, in this case, $250,000. The first thing we allow the clients to do if they need care is to take a certain amount of the death benefit every month on a tax-free basis to cover long-term care expenses. In this example, we're allowing them to take $5,000 per month from the death benefit. So if they need care and we write them a check for $5,000, the death benefit gets reduced to $245. If they died at that point in time after needing care for 1 month, the beneficiaries would get $245,000. If you did the math, that death benefit in this example is going to last for 50 months, which is a little over 4 years. Now that might be enough, but again, really popular on our policies is to add one of these riders. Now there's always going to be two riders that you can add. The first rider is going to double your duration. So if you had a 50-month base policy, the first rider is going to give you an additional 50 months for 100 months total. But what's much more popular than that, probably 90% of the riders that we sell, is this lifetime rider. The lifetime rider comes at an additional cost, which I'll explain in a moment, but here's how you want to think about it. If the death benefit ever runs out, in this case $250,000, and the client still needs care, we, the insurance company, OneAmerica, are going to continue to pay the monthly benefit for as long as that person lives. There is no maximum duration nor a maximum dollar benefit. As long as they live, we will pay their benefits. To me, it's the best thing that we offer. It's the only policy in the market that you can say to your client, I guarantee you, no matter how long you need care, this will never run out. Now, that feature is very reasonably priced. What we're looking at here is actually a joint contract for a 64-year-old couple. If they wanted to buy that rider without inflation, it's $1,200 per year. They could pay it monthly, $100 a month. That covers both people, and it's guaranteed to never increase. It's a guaranteed non-cancelable premium. But you don't have to pay for that rider annually. You can also pay it as a lump sum. And here's another thing you can do if you really want to get creative. You can take the price for the rider, you can take that out of your single premium. Let me give you an example. Here's a quote, a sample. Okay, my computer's acting up here. Here's a sample asset care quote for a couple age 65 and 63. Now, before I get into the numbers, I want to explain a couple things here. I mentioned that we're the only company in the industry that's offering a lifetime benefit. We're also the only company in the industry that offers a joint life-based long-term care product. So every other company out there that's tried to mimic what we created only has policies that can cover a single person. And I'll tell you why. When we created the product, we thought it was so unique, we actually applied for a United States patent on the joint life insurance policy with long-term care benefits. We now own that patent. So no other company can offer this. Now, it doesn't have to be a married couple, although that is the most common version that we offer. It can be any two people with an insurable interest on one another, provided that they're within 25 years of one another in age. So max age difference is 25 years. Let me give you some examples. Obviously, married couple. How about boyfriend, girlfriend who share money? For all intents and purposes, they might as well be married, but they're not legally. They can have a joint policy. Same-sex couples can have a joint policy. Siblings. How about a mother and a daughter? And if I have time, I'll touch on that one for a bit. So this is a couple that had $150,000. And what we did here is we included the price of the rider into their premium. So we took their $150,000 and we took a little bit of their $150,000 to pay for the rider, and the rest went into the actual policy. So here's the benefits that they get for their single premium of $150,000. They get a death benefit of $259,000. Again, the best thing there is you can say, you know what, if you never need care, you didn't lose a dime. In fact, not only did your family get back the $150,000 that you put in, but your family actually gets back an additional $109,000, and it's tax-free. Monthly benefit on this plan, $5,180 per month per insured, per person. A lot of people ask if we've got a joint plan and the benefit's $5,180, do they have to split that if they both go on claim at the same time? No, the monthly benefit is available per insured. They're both on claim at the same time. We pay $5,180 to him and $5,180 to her. Again, the first thing that they're going to do if they need care is we're going to start sending them checks that are depleting their death benefit. In 50 months, that death benefit's going to be gone. But we've included the lifetime rider on this contract. That means if the death benefit ever runs out, we're promising not one, but both people that no matter how long you're alive and you need care, we're going to cut you a check for $5,180. Here's, just to illustrate how powerful that is, I normally give clients an example. And you can give them whatever example you want to, but here's my example. In this blue box here, this is not actually on the quote. I just added this here for training purposes. $5,180 per month is over $62,000 per year each. In a hypothetical scenario, let's say the husband has a stroke and needs care for 6 years. He's going to get $372,000 out of the policy. Say the wife has Alzheimer's and she needs care for 8 years, she could receive up to $497,000 out of the policy. In total, in that example, the policy paid over $870,000. Now, I'm not saying that's the most this could pay out. The most it could pay out is unlimited, depending on how long they need care. But I like to give people an example just to show, you put in $150,000. If you need care, you could take out $600,000, $700,000, $800,000. And if you never need care, your beneficiaries get $259,000. So what we're trying to do is we're trying to create a product that really didn't have any objections that we couldn't overcome. Now, depending on how you structure the plan, the cash value is going to operate a little bit differently. This one here, they put in 150. The cash value starts out at 128. Why is that? Well, we employed kind of a unique strategy here. We took 20,000 or so, 21,000 of their 150 and used that to buy the rider. So that money is not refundable upon cancellation. Cash value starts out at 128, but if I keep this policy for maybe 10 or 11 years and then I surrender, I can get all my money back. So we can overcome that objection as well. Well, what if I like this plan, but what if I need this money for something else? Well, I'm glad you asked. Now, depending on when you surrender this plan, you might lose a little bit of money. You might get all your money back. Or, let's say I surrender in year 20. Or you might even get all your money back plus interest. So that's called Asset Care 1, and obviously we'll open it up for questions on that at the end. I made a comment a few minutes ago. I said, Asset Care is the only asset-based product out there that has true flexibility in how you can fund it. Well, let me go to the opposite end of the spectrum, the other extreme. One extreme is single pay. The other extreme is I want to pay the least amount that I can per year. And the way you do that is with annual premiums on Asset Care. We call it whole life Asset Care. So here's a little bit younger couple, 60 and 57, and they wanted to pay it annually. Well, there's two premiums, one for the life insurance, that's $46.31, and the other premium is if they want the lifetime rider. In this case, it's $24.27. So the total premium for this couple, 60 and 57, is $7,058 per year. What do they get for that in this case? Well, there's a lot of flexibility in how you can structure our plans, and I'm not going to get into all that today. Today is sort of a high-level overview of the products. Just as a commercial, we are going to schedule follow-up webinars to this to really drill down on each of the products individually. But I used a little bit different structure for this couple to increase the monthly benefit here. What they get for $7,000 a year is they first get a death benefit of $175,000. So, I'm paying this like traditional long-term care, but it's got a lot of differences. The first one being a death benefit. And so if they pay this thing for, doesn't matter, 1 year, 2 years, 10 years, they die, their beneficiaries are getting a $175,000 death benefit. For long-term care, they get $7,000 per month each, $84,000 per year each, with lifetime benefits. So just like the last one I showed you, as long as they need care, we'll pay $84,000 per person. The other thing that they have is a guaranteed premium. So this premium, $7,058, you can look your clients in the eye and you can say, you will never have to pay more than $7,058 for this policy. It's in the contract. It's called guaranteed non-cancelable language. The last thing we have here is, again, cash value that builds. I don't want to say a return of premium because depending on when they cancel, they're not going to get all their money back. But the glass is half full, not half empty. When people look at this, they don't say, well, if I surrender in 20 years, I'm not going to get all the money back that I put in. No, because, on the alternatives that they've seen, they don't get anything back. So anything that you get back here is gravy. If people love this, whoa, if I cancel this policy, I'm going to get some of my money back. That's great. So death benefit, guaranteed premiums, cash value, and lifetime benefits on an annual pay policy. They could pay it monthly if they wanted to. Automatic deductions from their checking account. Running a little bit low on time here depending on the stuff that I definitely want to cover, but I mentioned there's a third version of Asset Care that's funded with money from IRAs, 401ks, other types of retirement accounts. This is a really, really popular product that we have. And the reason why is if you think back to the original sales presentation that I talked about, you know, we ask clients, can we agree that if you did need care, you'd have to spend some of your assets to pay for it if you don't buy long-term care insurance? Everybody said yes. Well, have you ever thought about which one of your assets you would likely use first to help you pay for care? A lot of times people say, you know what, I've got most of my retirement money is in my 401k. It's not uncommon for people to have $400,000, $500,000, $700,000, $1 million in their 401k, believe it or not. The reason why is that generation that we're selling to, that baby boom generation, that's how they were told to save for retirement. You invest, maybe your company matches, it grows tax deferred, it's pre-tax. You know, so they were given a lot of incentives to save that way. A lot of people have money in IRAs, 401ks that they don't need for income, and frankly, they don't know what they want to do with it. Well, I hate to break it to you, but using money from your 401k to pay for long-term care expenses is the absolute worst place you can get money to pay for long-term care expenses, because every dollar that you take out is taxable. And if you need $100,000 a year, you probably have to take out $150,000 out of your IRA in order to have enough money after tax to pay those bills. So we created this product. It's the only product in the industry like it, the only product that can be funded with a single premium of qualified money. And it works very, very similar to the original Asset Care. You'll notice all the quotes look very similar. The couple, we can do a joint policy. We can add that lifetime rider. In this case, it's $1,300. Well, what's the difference? Well, the main difference is obviously going to be taxation. And why is there going to be taxation? Well, this $150,000 that we're proposing that they move into the policy has never been taxed. And obviously Uncle Sam doesn't like that. They want to get their taxes. So we can't move qualified money into insurance without taxation. What we've found a way to do is not avoid the taxation. There's no way to do that. But at the very least, minimize the effect of the taxation on the client. Instead of having them pay tax on the entire amount of the premium in the year in which they pay it, we allow them to spread the tax liability out over 20 years. In this example, the policy is being funded with $150,000. They're only paying tax on $9,789 per year. That doesn't mean they're paying $9,000 in taxes. That means they're getting a 1099 for that amount. It's counting towards their income, and depending on their tax bracket, they're paying taxes accordingly. Now, keep in mind, this is money that they would have to pay tax on anyway at some point in time. So we're not creating a tax burden on them that wouldn't otherwise exist. We're just giving them a specific purpose to pay those taxes by using that money to help them pay for care. Very, very popular product. Now, before I move on to annuity care, just a couple things. The maximum age on all asset care policies is 80. We do go by actual age. So until someone turns 81, they're eligible for asset care. Depending on the product, the minimum ages are different. On the annual pay product, the minimum age is 20. On the single pay cash, the minimum age is 40. And on this product here, because of the nature of it with the distributions and everything, the minimum age is actually 59 and a half. Now, of course, there might be some exceptions to the minimum age. The maximum is pretty firm. If someone has turned 81, unfortunately, they're no longer eligible for asset care. Here's the other thing I want to mention before I move on. I'm going to talk about an annuity product here in a minute, but there's other companies out there that have annuity products, and what they're going out there trying to do is, you know, fund our annuity products with cash. Well, I want to tell you that that's not the right thing for your client. If your client is in good health and they have cash premium, you get much better bang for your buck on the life insurance product. I know of a couple companies out there that they don't offer a life insurance product. All they offer is an annuity with LTC. And so it stands to reason that they tell you that, you know, everybody is good for this product. That is not true. The annuity product is only good for a very specific few types of people, and I'll explain that right now. So when you think of the annuity product, you want to think of two different types of people. As I skip through all this here. The annuity product is good for, number one, someone who has an existing annuity. If they have cash, it's probably not the best product. Asset care would be much better. Annuity care is good for people who have an existing annuity that they want to do a 1035 exchange into annuity care and get long-term care, whereas their current annuity does not have long-term care benefits. So that was really the main reason we created it. Now, occasionally we will recommend that you use cash to fund annuity care, but it's only if the client is in, let's say, average health. So let me just reiterate. Annuity care is generally funded with a 1035 exchange from an existing annuity, or it can be funded with cash if the client is in average health. But you would not want to use any annuity-based product on the market if the clients have cash and they're in good health. That's just not the best thing for them. So here's how Annuity Care 2 works. They're going to take, and now this is single premium only. They're going to take a premium and they're going to put that into an annuity. The annuity may have some growth on it. It may have a little bit, it may have no growth at all. Essentially, when they need care, if it's a single person, we're going to take the cash value of the annuity, and that's going to pay the first 2 years of their long-term care. At that point in time, we have these optional, well, no, they're not optional riders on annuity care. They're included. After 2 years is up and the client has spent through the cash value of the annuity, the insurance company is going to step in, and we're going to pay for their care for a specific number of years after the first 2 years. The first option is a 3-year continuation of benefits rider. So again, the annuity value we spent in 2 years, the insurance company would pay up to an additional 3. The second option is a 6-year continuation rider, where the annuity is used for 2 years and the insurance company pays up the additional 6. And the last one is an option for an additional 9 years. If you add the 3-year rider, you end up getting a total benefit that's 2.5 times what your initial premium was. If you put in $100,000, you'll have up to $250,000 for long-term care. If you choose the 6-year extension, you'll get 4 times your initial premium. You put in $100,000, you get $400,000 for long-term care. And the 9-year rider is not very popular right now, but if you did choose that option, you put in $100,000, you'd have up to $550,000 for long-term care. I think there's another company out there that is trying to do a product kind of like our Annuity Care 2, and they'll give you either 2 times or 3 times your money, and those are the only options. So when I get asked a lot, what makes your product different than this other company? Well, with them you get 2 times or 3 times. With us, you get 2.5 or 4 or 5.5 times leverage. Let's look at a quote, and then we'll open it up for questions. Here's an illustration for our Annuity Care product, Annuity Care 2. It's for a 65-year-old woman. This product can also be joint, but I just decided to show the illustration here for single to change it up a little bit. I've chosen to illustrate a premium of $125,000. Now, by the way, with all of our products, we'll take almost any premium. It can be down as low as maybe $20,000 to $25,000, upwards of $500,000 in premium. So I'm just using these amounts to illustrate, but we'll take almost any amount of premium. Here, I mentioned the annuity value is always going to cover the first 2 years, and then we get to add these optional extensions. We've chosen the 6-year extension here, and I made the claim that that would give you about 4 times leverage on your money. And if you notice, $125,000 premium here turned into a benefit of $504,000. Now, that's not a death benefit. That's a long-term care benefit. The way the annuity-based products all work is if your client dies, your beneficiaries get the cash value. And this is why I'm telling you that If the other company says, yeah, healthy people with cash, this is a great product, well, no, it's okay, but Asset Care is better because Asset Care gives you a death benefit and long-term care. The annuities don't. Generally speaking, this is going to be for someone who has an existing annuity that they want to roll over into it, or it's for somebody that has cash and they're not in great health. If I die here, my beneficiaries get the cash value. But of course, the reason to buy it is if I need long-term care, I had $125,000 and now I've got $500,000 magically just by moving my money from one type of account into another. I didn't talk about it today. Maybe we'll talk about it on a future webinar. But there are other versions of annuity care that go up to age 85. So if you have clients who are between 81 to 85 and you didn't know if there was an option out there for them, we do have two different versions of annuity care that go up to age 85 and the clients are eligible until they turn 86. Few words on underwriting. Asset Care is slightly harder to qualify for than annuity care. But even Asset Care is a little bit easier to qualify for than traditional long-term care insurance. The reason I say that is at least a handful of times per month, I get applications submitted that were declined by another carrier for traditional, and we're able to offer that person coverage. So you want to think about it like this. Traditional, whatever the underwriting is there, Asset Care is a little bit easier to qualify for than that. And then annuity care is even easier to qualify for than Asset Care. Annuity care is underwritten with a telephone interview. There's never a medical exam, never a review of medical records. Obviously, we do check the MIB, but there's a telephone interview, and that's the extent of the underwriting on annuity care. On Asset Care, we may be able to underwrite your client with a telephone interview, but it's also possible, depending on their medical situation, that we might have to dig deeper and do full underwriting. Let me just touch on a few things that we're known for in the industry. We're a very reasonable underwriter of long-term care. And here's the reason I say that. Think of things like diabetes. We will consider and often approve insulin-dependent diabetics. Think of some of the other companies out there, insulin-dependent diabetics with automatic decline. We will consider insulin-dependent diabetics. Our build chart, height and weight chart, much more liberal than some of the other companies out there. Probably at a given height, maybe 20 pounds more liberal than some of the other companies. So if you're struggling with a client who, has borderline health, I'm not saying that we'll accept everybody that wants the coverage. We still have to be responsible. But if you've got a client that has borderline health that, maybe just on the cusp and another company wouldn't take it, give us a call. We'd be more than happy to look at that for you and see if we can consider that client. So that's all I have for today. Again, the goal here would be to, follow up with additional webinars in the future to learn more. Today was sort of a high-level overview. But if you have questions on this, you like something you heard about today, you want illustrations, feel free to contact AIM. Their phone number's on the screen. You can also call me directly on my cell phone or email my internal wholesaler, Andrew Bailey, and we can help you with quotes, product questions, etc. Thanks again very much for your time. Do we have any questions?
Yeah, Evan, thank you very much for doing this webinar. We do appreciate it. And a couple of notes before we open up the phones. One for you, Evan, is maybe it's easier to say where you're not approved at than where you are approved at. But I did have one person wanting to know about California. So if you could mention on that.
Every product and feature we talked about today is approved in California and 49 states, with the exception of New York.
Okay. So, like I said, a lot easier to do that than going through where they are. So, for everyone's listening, is the product is out there everywhere, other than New York. And New York, if there is anyone on there in New York, you pretty much understand why you got to have brick and mortar in New York to do business there, and at this time they do not have that. So with that being said, I'm going to open up the phones and give you guys a chance to ask questions if you would like to. Again, if you didn't put in that PIN number, I'm not going to be able to unmute your phone, but give me a few seconds here to do that. I want to mention to you that we do this One America along with other products too, just to make sure that we're covering all your guys' needs with the long-term care. And I thought Evan did a really good job of explaining where the difference you might use a linked product, an asset-based product versus a long-term care, and also why you would use their product and the potential of having benefits that other carriers may not have available in their plans. So with that being said, I've got a lot of you guys on mute. I'm still working on it. If there's anyone that has a question right now, go right ahead and ask.
Hello?
Yep. Hi.
Oh, hi. On the life product that's joint, if one person dies, how does that affect the benefit of the survivor?
Great question. Now, just to clarify, it does not have to be joint. We offer single policies as well. Everybody does. The reason I talked about joint is we're the only company that offers that one. Upon death of one person, essentially nothing happens. The death benefit is not paid out, and there's a good reason for that. If the death benefit was paid out, the policy wouldn't exist anymore, and there wouldn't be any benefits for the surviving spouse. So when one dies, nothing happens. In my example, my first example, they had $5,180 per month forever. If one person dies, the surviving spouse still has $5,180 a month for as long as she needs care.
So what's the benefit of getting a joint? Why not just get two separate?
There's massive benefits on getting a joint policy. The other day I was in a meeting with a guy, and he asked a question, and I said, well, do you have a particular product that you normally use? He said yes. I said, okay, go grab their rate sheet. Okay, so he went and grabbed their rate sheet. And I was showing this illustration here, okay? So he grabbed the rate sheet, and what he did, we looked at, what could I get for $75,000 for a 65-year-old man and $75,000 for a 63-year-old woman. Why did we look at that? Well, again, you can't do a joint with these other companies. You had to do single. So because they had $150,000 to work with, we split the premium like that, okay? And with single policies, the husband got around $3,900 a month in benefit with a maximum duration of 6 years. And the wife got about $4,300 a month in benefit with a maximum duration of 6 years. Now, that was with the competitor, and it would be similar to that with us. So the bottom line is you get much more bang for your buck on a joint policy. If you split the premium in two, you would not be able to get $5,180 a month for lifetime for both people. Okay. Does that answer your question?
Yeah. On the annual premium, I guess asset 4, can one put in more money at a certain time if they're not liquid right now, but can they put in more premium at a different time in the future?
No, they have to sign up for a separate plan.
Oh, okay. All right, thank you.
Are we completely clear on why joint is better than single? I mean, essentially, you get a lot more bang for your buck by putting two people onto one policy. In my 6 years of doing this, I've never had a situation where it worked better to split the people into two different contracts.
Okay. Yeah. Okay. Depends on the situation, though.
Well, I've run 1,000 quotes. I've never had one where it made sense to put them onto separate contracts.
Okay.
Okay. There are some other questions. Now, again, I've unmuted as many as I could. There are some of you that I was not able to unmute. You must not have put a PIN number in. But there are some questions. Again, there was someone that wanted to know what the ratings were across the board with it. We did talk about the Comdex. We did talk about the A+ rating with Best. Do you happen to have Moody's or S&P?
Yeah, our S&P is AA-. We don't have a Moody's because we don't, most companies of our size, we're about a $70 billion company, only have about 2 ratings because it costs about $250,000 a year to be rated by these companies. So we're AA- AM Best. Just to give you an idea where that puts us, out of about 500 insurance companies in the United States, there are only 30 that have an A+, AM Best, and a AA- S&P.
Okay. Also, are premiums waived when claim with the Asset 4? Are premiums ongoing for both insureds or only one insured?
So it depends on whether you add the waiver premium feature here. And you'll notice on the screen, these numbers that I'm showing you, the waiver premium was added, and the total premium is waived if one person is on plan.
Okay. Okay. Next question would be, what is the sweet spot in underwriting asset care? Do you have any that you have run across where underwriters are a little bit seem to be easier than other products?
Across the board, we're a little bit more liberal than all the other companies out there. It's not just cancer or just diabetes or just arthritis or just pain medications. I mean, it's just across the board. We're just a little bit more reasonable on underwriting than some of these other carriers.
Okay. Does the annuity go away at death, or does the beneficiary get both? Not quite sure what that question
on that one? No, the beneficiary on Asset Care 3, I'm imagining is what you're referring to. The qualified money product, the annuity actually gets partially qualified money and partially death benefit when they die. So they would actually get both to answer that question. Now, David, okay. I'm really sorry to do this, but I've got another webinar that I've got to jump on right now. So maybe you can compile a list.
Yep, we'll get these questions out. And again, if you need something, give me a call and email me. We'll talk to you guys soon. Thanks.
Thank
Thanks
you.
A lot.